Hysaj Research Associate at CCFI and Center for Green that is working closely with Imperial College as well as grant funding supporting startup businesses for climate FinTech. I'm pleased to have with me today Yllka Bevan from Senior Associate from Venture Capitalist and ZINC VC as well as Karen Elliott from UKFin Plus Network and Professor of Practice and Finance and FinTech from University of Birmingham, and Amos, co-founder and chief executive of Dovetail Finance, that will be open the discussion of the panel with a presentation of what an example of the climate FinTech will be. Amos, over to you.
I'm Amos, CEO of Dovetail Finance, and I've been given the chance to open here by presenting for just a few minutes on what we do at Dovetail. And very relevantly, we're actually in the process of raising a funding round. So I'm doing quite a lot of pitching at the moment, but I think for this audience, I have the privilege of saying a whole lot of things that are hopefully neither very surprising nor very pretentious. Dovetail builds data to help investors navigate the climate transition. And I've messed up my slides, so in the wrong order. But we do that because climate is the biggest macro that every investor is going to deal with for the remainder of their careers. And that means that really it's an element of fiduciary duty to consider climate risks and climate opportunities in each investment process. And so, for example, we estimate that there's a net exposure of about $190 billion in terms of equity risk in net present terms, and that's just for publicly traded UK companies and just looking at transition risks. So serious scale of risk, but also meaningful opportunity. And then from a risk perspective, it doesn't really matter if you don't believe that we're ever going to get anywhere near net zero. So the world is warming up, and that presents a set of existential challenges to which we have to respond, and indeed to which we have been responding for at least a couple of decades already. And we're responding by adapting to warmer, weirder, more extreme weather, and we're responding by reducing emissions, tackling the problem at source in a multitude of ways. So we know that the transition is going to involve a mixture of adaptation and mitigation. We just don't know what that mixture exactly is going to be. I think from an investor's perspective, any outcome, any mixture of those two things involves both financial risks and material opportunities for each firm and for the securities that it issues. So for example, adaptation could mean higher insurance premiums, disrupted supply chains, increased demand for cement to shore up building foundations, and the mitigation could mean stranded assets, carbon taxes, competing green technologies, and so on. And then also from an investor's perspective, this is really playing out across the whole firm. So your regulators are demanding stress tests and disclosures. If you're going to go reveal a set of risks to a regulator, then you probably want to make sure that those are managed in the investment process. And then finally, there's also a real opportunity to invest in climate upside and build differentiated financial products that capture some of the $50 trillion or so that Bloomberg predicts will be managed in line with an ESG or climate standard by 2025. So clearly, the best way to assess firm-level climate exposure is bottom-up. You can't really beat that, but that's not realistic for small teams of overworked ESG professionals, and then only really a very few investors have sufficient teams with deep climate expertise and concentrated enough portfolios for that to be realistic on a deal-to-deal basis. So there's a need for a systematic approach as well, and that's what we provide. And we develop models that outline climate exposure in dollar terms, at firm level, with high transparency, not necessarily to replace detailed bottom-up analysis, but to enable it to happen consistently and at scale. And our approach is scenario-based and cash flow-based, so our inputs are financial statement information, basically. We're not just doing a kind of scope 1 multiplied by carbon price, simplistic view on carbon risk. And since financial statement information tends to be quite consistently available, we can cover 40,000 listed equities out of the box, and we can cover unlisted markets as well if we have financial statement data. The value of this kind of climate economics and cash flow-based approach is that it allows you to think quite concretely in financial terms. So traditional ESG metrics, carbon intensity information, they are both really valuable data points. They just don't speak consistently to financial exposure. And so, for example, you have a set of companies that have high carbon emissions by default, that have complex operations in the global south that may well struggle to have good ESG scores, but that are doing things you really want either for mitigation or for adaptation. So mining for nickel or shipping sand around the world would be two classic examples. And then on the other hand, you have companies, perhaps in the software sector, that have very low emissions, have an easy time of having a good ESG score, but are selling into industries that are disappearing. So have very high risk in financial terms. The outputs of our modelling leverage that economics-based approach, and we offer as much transparency as we can in terms of demand forecasts, raw material cost trajectories, energy mixes, and so on. So not just a black box, but where do we get those numbers from, and what are all the assumptions sitting behind our modelling? That hopefully explains why we see this as a data problem and why we feel that we're particularly qualified to work on it. My co-founder and I built out Palantir's client-facing climate data team prior to founding Dovetail. Philip's background is a PhD in computational physics, modelling sustainable energy systems. I was a financial journalist. I wrote about a different kind of set of risks and compliance processes around money laundering and terror financing. But I think just to wrap up, Paul, on the last panel, you talked about getting climate data to speak the language of investment. I think for us, it's our experience turning big, complex data into investment-grade intelligence that we hope allows us to contribute to breaking that language barrier between climate risk and financial risk.
Thank you very much, Amos, for your presentation. We just see that Dovetail Finance is a great example of the climate fintech, and we have seen throughout the years that climate technology and financial technology have been evolving separately, while much can be done if these two communities come close together and share their knowledge, skills, and technology in helping to tackle climate change. For that to happen, we know that there is a need for additional funding and support from growing businesses as well as early career startups. So I would have over to Luke to give an overview of ZINC VC and what are the climate, fin, and tech investments that you have made on.
Thank you. Thank you so much, Yllka. Great presentation, Amos. So I work for ZINC VC. We're a rather unconventional organisation. We do a whole load of different things, but at our core, we're a VC and venture builder. So that means that we invest in some external startups. I do that around, it's a new part of our business around deep tech. But the core thing we're known for is building businesses from scratch with big cohorts of exceptional people around tech for good themes. So we think that early stage businesses are like a fantastic way of trying to make change in the world. Separate to this, we also run commercialization programs for academics. So we really live at the very earliest of early stages of finance. So I apologise if I have a slightly myopic view of the stage of businesses where it's all hopes and dreams. We've made a couple of investments into climate fintechs. So when I think about climate fintechs, I sort of have a bit of a naive mental model in my mind of, on the one hand, we have Dovetail and Amos are a fantastic example of companies who are looking to help catalyse capital allocation into either mitigation or adaptation in some way. And on the other end, I think of climate fintechs around things such as trying to put values. Sorry about that. Trying to put value on either decarbonisation or natural capital, people participating in things like voluntary or involuntary carbon markets. So some examples of things that we've looked at, we have a portfolio company. Venture capitalists are in the business of hyping up their investments, but I am genuinely very excited about these two companies. We have a company that we work with called Granite, who are trying to unlock basic hardware loans for SMEs. They've noticed major dysfunctions in the way that climate assets are risk models work for climate assets for SMEs. We also have another company that we work with called Unibloom, who are looking at the helping publicly listed companies do scenario planning and manage the triple bottom line of people, planet, and profit.
There are quite a few opportunities at ZINC VC for pre-stage and early career startups for investment. How about the UKFin Plus network, Karen, an overview on that funding opportunity?
Okay, bringing that all together, we've heard today a lot about complexity and different nested systems. So when I transitioned from industry to Durham University, I found a lot about complex adaptive systems thinking to look across the social, the economic, and the environmental domains as to how we're using and implementing tools. And the UKFin network came out of that. I sat on a round table about 2.5 years ago to say, what is the future of FinTech? And a lot of the topics we're discussing today came up. So I advise from a academic perspective that rather than going down the route of traditional research, why don't we open it up to collaborative R&D projects where any industry in the UK can work with academics across any university across the UK and apply to this network for funding. So at the moment, we've got our first call of funding out around agile projects, so you're developing your MVP, and then they stack up in terms of technological readiness level. So you can go from the MVP to a feasibility, piloting this as well, and then to a longer term 100K investment to actually impact that, because academics are now being pushed not to just produce papers, but actually produce societal impact, which I'm really interested in. And all discussions we've heard about today is this nested system. If you think about it, the social, the economic, and the environmental systems are all interdependent. No matter what we do, it has an impact somewhere within those systems. So what we're calling to do in the UKFin, again, it's a collaboration. We've got Will Nottenbell here, professor at Imperial, myself and Advan Morsel, who are at the University of Birmingham. Art is head of computer science, and I sit in that social technical space. So I've done machine learning courses. I understand the technical as well as the social implications, and I also am a big advocate for the voice of the financially excluded and also the impacts on society for them. So the chap was talking from Westminster Council. I have an idea which I can float here about alternative investment, because I just came back from Cybos, one of the largest finance and fintech conferences in the world in Canada. And whilst I was there was a warning about flooding in the area and our flights might be delayed back. And it's also relevant for today. But whilst we're there, there is a lot of money in finance and they're all investing. But why don't we look at how we can go beyond corporate social responsibility to corporate digital responsibility as well? Because everything I would say most people do in this room has now transitioned to a digital platform. Some still hybrid, but mainly you have a digital presence. So there is a level of responsibility there, irrespective of size, to look at what you're doing across that supply chain, from ethics by design, i.e., are there going to be any unintended consequences of what you're doing around AI machine learning? So like Amos's models, where is this data coming from? Can we prove the authenticity? Can we come across the transparency, work around the black box problem? Everybody knows what the black box problem is, right? Yeah? Good, don't have to explain that one. So what we're looking at there is for you to apply for funding to tackle some of what I call wicked problems. What is a wicked problem? I found out at Durham University this is a problem that you cannot resolve, like financial inclusion, poverty, climate change. We will never fully resolve it, but what we have to do is iteratively manage the challenges as they come up. Hence, they're wicked. As my son, when I was 5, he was 5 when I was studying, was going, wicked. I went, not quite that wicked. Wicked as in, they are very difficult to resolve, and we need collective people like yourself to collaborate to get things done. I think, as Emma called, we now need to push forward and get things done. And I was sitting here thinking, yeah, we need to put together the pieces of the puzzle, working across universities, working across industry, which is what the UKFin network is aiming to do over the next 4 years, to get the best brains on both sides. Because I know when I was in the industry for nearly 20 years, there were people in there who could equally be sat here as a professor, the same as myself. They just choose not to be. But if we draw those brains together, people like Emma, etc., are going to get more information. Amos is going to provide more data. And actually, one of my colleagues at the moment in industry, a primacy company, what they've done is taken legislation from the FCA, from the UN, and made it into machine-readable regulation. So you're already compliant with the FCA regulation in this country or US or wherever you're operating. He's currently sat in a meeting with Innovate UK where we were accepted to go forward to build an ESG data hub, okay, to have an open access data hub to do data metrics like Amos is doing. So Amos, I might ask you to join our consortium because again, we need more brains and more data to look at the validity in the era of ChatGPT. Where is this data coming from? Is ChatGPT just learning and making it up? And therefore, how are you going to investors know the authenticity of that data in order to get ROI? In industry, I have the lucky background of being a risk and change manager, so I'm well aware of like the risk concerns and appetites that investors have. In terms of alternate versus versions of investing, I got thinking about financial exclusion and how we could get companies to not look at the government for money, because there isn't any, right? If we're honest, there is no money for our government to do much more. So I'm working with a FinTech, so using the area that I'm in, who actually takes your investment, looks at how best to get return. So an example, the University of Birmingham has 192 million sat in Lloyds Bank. Okay, if Lloyds Bank went bust, as SVB did earlier this year, 85,000 of that is guaranteed under FCA rules. The rest, kiss it goodbye. So even if we took 10 million out of the university, gave it to Cascade, they did this wealth investment management. The interest that you get back, you give half to the university, half of it goes into a corporate digital responsibility fund that then can be distributed for some of the cases and projects that we're looking at today to boost Dovetail and their innovation, also give back to food banks and other things like this. So we've got like the extension of social responsibility because we're looking at the social, economic and environmental impacts of what we're doing in the digital era. So that's been my thinking for the last while, and also my shout out is to engage with our network, help spread that it's there. We've got money to give to you at Cybos. It was an easy sell. I was going around all the platforms going, I've got money to give away. If you're based in the UK, you can access any academic. I spent the last 6 years going up and down the country, working with the FinTech National Network and Innovate Finance here in London to see how we can work better between academics and industry to solve some of these wicked problems that come from the complex adaptive systems that we're in. So that's kind of my pitch. If you want to know more about it, I've left some flyers the way you can get information for our website, to speak to our project managers. And also, if you think the CDR fund is a good idea, also contact me about that and see how you can maybe look at your investment and saying to your investors, if you want to go beyond CSR into the digital era, this is how you have, responsible investment to actually give back and fill some of these funding gaps that we've got that brings everybody in society through as well to what funders are calling an equitable digital society. If we want it to be equitable, we've got to change the way we invest, think about our interests and how we proportion it so that we all move together. And the people on the lowest incomes in the country are not the ones who are really suffering the most when we have these environmental damages, because they can't afford insurance, they can't afford to move. It impacts on their jobs, their mental health and their well-being, which comes back to finance, okay? That's it.
Thank you very much, Karen. That's quite an impressive overview of the ecosystem of FinTech as well as the climate and how well we can collaborate together. Just coming back to you, Amos, on your pitching presentation of Dovetail Finance, and what will be an ideal seed funding and why that you will be looking for?
An ideal funding round.
Yeah.
So we started off raising venture capital. We went down that very traditional venture route. And it was only really after we'd raised that first round that I learned that is not the only way to start a business. And so when we think about the round that we're doing now, our second round, I hopefully have a slightly mature perspective. And I'm putting together a round that is conventional on the surface and entirely unconventional beneath the surface. And that's, I think, because I realized that whilst you can get huge value from venture funds, and we've had great relationships with our investors, the best use of venture capital is to help you raise more venture capital. So you do want a sort of a lead investor who's a brand name with a lot of recognition and is well connected, because when I'm going out to raise not a few million, but 10 million, whatever it is, then I will need the access that they bring to those much bigger, well-known funds. But by far the most useful ticket, the best part of our cap table, has been Professor Cameron Hepburn, who invested an angel ticket of £50,000. And that's because introductions that come from someone personally, and when you have someone's personal investment literally and figuratively in the business, they are much more meaningful than introductions that come from a fund. And I think whilst we really appreciate some of the networks that our existing VC investors have provided for us, sometimes you do join those calls and you feel that the counterparty is sort of thinking, not another one. Whereas when it's a personal investment, that carries through a lot of the credibility of the individual making the introduction. And so for this round, I think it's a lead investor who can help us attract follow-on funding and is a well-known VC, and then really a lot of strategic angels and smaller syndicates underneath that.
Thank you very much. So we kind of agree that there is a great opportunity for early career startups for investments, and as well as ecosystem that supports, and we can collaborate across these sectors. But at this level, we are still facing with an lagging behind of the investment, and in particular from private investment. So a question for you, Luke, why private capital are hesitating to invest in the climate fintech?
Yeah, it's a good question, and I both agree and kind of like disagree with the premise of whether or not private capital is holding back from climate fintech. So in the venture space, as a result of the global downturn, there has been a bit of a downturn. In climate, it's been a little bit more resilient than other areas, but in the first 2 quarters, everything was down about 40%. That's now kind of picking up a bit. And there's, green shoots and things like this. But there's a number of we can think about, sometimes within climate tech, people think about the finance corner of climate tech, and sometimes within fintech, some people think about the sort of climate-y corner. Thinking about some of the ways in which some fintechs are trying to engage with quite immature markets can put some investors off. Carbon markets, especially voluntary carbon markets, have been growing very quickly and are tremendously exciting. And the potential for voluntary carbon markets to really pick up the slack in dealing with offsets for hard to abate sectors is really exciting. But at the moment, voluntary carbon markets are still dealing with essentially commodities that are they're not commodities. A ton of carbon is actually quite a highly differentiated thing that you're selling. There's huge amounts of marketing that goes into selling carbon offsets. So it's maturing very quickly, but it's still kind of yet to mature. But however, there are really, really exciting things happening for climate fintechs. There's been some massive raises of rounds. Just listing a few, B0 last year raised about $50 million on a Series B. Silvera earlier this, dropped my pen. This year, I shouldn't twirl my pen so much. Silvera raised about 57 million. Plan A, everyone's been talking about a couple of weeks ago, raised 25 million. A lot of these are around carbon accounting and also ensuring the quality of offsets. That's what Silvera do, and people like Opna, who also raised a recent round. So there's actually quite a lot of really exciting stuff going on, but still, depending on the particular niche that you're looking at within climate fintech, there are reasons why later stage investors and people might be a little bit hesitant to get involved.
That's impressive. So to follow up also in a previous panel discussion, there was quite a key points related to the trust of the data and how this data can be translated into econometrics or financial models to make sense for financial investors. So I would like to give an overview of your wide experience with fintech community. So would you think that human and tech trust would play a key role of attracting investment within the climate fintech?
Yeah, well, we did some research about 3 or 4 years ago about what is fin trust, so how does trust pan out from the social perspective, and then what does trust mean for the machine learning and AI engineers, and they're very different. Okay, so in terms of human trust, It's usually our interaction with people, and we get to build up that we can rely on that person to behave in a certain way, to have an integrity, benevolence, and the ability to behave in a certain way that we can predict. So every time we interact with someone, they're going to behave in the way we expect to, not be negative, etc. On the technological side, it's around transparency, fairness, and accountability of the technology that you're building to be as accurate as possible within the machine learning parameters, and that is trustworthy from a technological point of view. So we have like a very technical version of trust versus human trust. And how do we get people to trust in one another? Again, I think to Amos's point, we're now pushing for what's called explainable AI. So we're pushing back the black box aspect, which is still lurking down at the deep learning level. But when we're building on top, we're showing how we're using the data from the deep learning phase through the machine learning phase, aggregated in the AI, and then checking on what it's learning in the wild through our training data sets. So we can build trust in that way, but also, for me, technology always starts and ends with people, from the person who designs it to the person who uses it, how that person uses it, and then how that person feels about using that technology. And we still have a huge gap around that. So to build trust, what we've got to do is demonstrate, I think as Amos is doing, like the authenticity of where the data is coming from, how you're processing it, how you're categorizing it, making sure that you're checking for biases in that data, and then communicating, because we're humans, we want to know, we want to talk about, tweet about it, understand what the companies are doing around this word of responsibility. Now, it sounds twee, but we need to step up in responsibility. When you think about it, we all started recycling years ago, which we wouldn't have done when I was growing up, okay? We didn't do recycling, but now we see it as a personal responsibility around this whole discussion of planet, people, and preserving what we've got in terms of resource. So I think that is the demonstration of responsibility by having a credible tool that is tested by the users, recommended by the users, and then spread by word of mouth on social media, etc., but also by being open and transparent about what are the technological process, where are the parameters in the machine learning phase, what data are we basing on it, where is the authenticity, how are we demonstrating that the metric that we've got is open and can be tested and updated each time we go through an iteration of changing the model and learning from, scientific resource. This is one of the key things about the network, is to open up. What I found transitioning from industry to academia is there was so much knowledge in universities that just didn't get out there. And then when you've been through, like your colleagues have done a PhD, they realize that there is this body of knowledge. It's just academics are not always focused on sharing that or know how to share it. But if we can get through that, that's when you start to build trust, because you've got, we've got the scientific rigor that it's tested, not just by one person, it's reviewed by our peers to make sure what we're doing is processed, but also then throw it to the people and go, these are the stages we worked through. What do you think? Do you think that's reliable? What changes would be made? So user feedback and acceptance of the processes that I'm sure a lot of you are familiar with here. So that's how we start to build the trust and then spread the word and open to collaboration, have an open discussion about, how can you make us get a little bit better? And I keep saying this to finance companies, how can we do things just a little bit better? Because I know I'm talking about inclusion, but it's one of my bugbears that there's a lot of talk and discussion about financial inclusion. But there's also 9 million people in this country, probably even more, who are teetering on the brink of when they can afford a smartphone. Now, if you don't have a smartphone, you're not going to be included in financial technologies or the other technology around ESG. So we need to see how we're going to rectify that balance, and we can do that through trust and openness to going, how do we resolve these issues to make everything better? And that's how you start to build the trust in the metrics around ESG, because I think there isn't a week go by the Financial Times don't come out with another article of how it's being washed, which then, reduces the reliability and the trustworthiness of what people read. So we need to start pushing it the other way by showing, okay, we take that on board, now we're going to actually do something. So I think with the Amos job, there's a difficulty in a bit policing this. How do you test whether people are washing their measurements and metrics if they're not using something like Amos's tool or what AGA does with primacy? So we need some sort of benchmarking, and I'm hoping that we can do that through collaborations, and I'm looking to set up a Centre of Excellence for ESG at Birmingham, but it's open to all universities as well. So I think that's how we build trust.
If I could respond to that, just specifically with what we do, one of the ways that I try and build trust with our customers is that quite early on we tend to have a conversation where I say, like, our data's wrong, right? Like, you know that all forecasts are wrong, and actually, let's imagine that I could build this box that spat out a number that was a perfect prediction of the future. You wouldn't trust it, and you wouldn't listen to it, and it wouldn't be useful to you. So really the exercise here is not to accurately predict, it's to build the best possible version of a set of models that reveal the directionality of risk, the magnitude of risk, and ultimately allow people to understand sensitivities in their portfolios and so to make them more resilient. It's not necessarily to be right.
No, it's just better. That's all we can do. We can just incrementally get better. We can't make it perfect because nothing's perfect.
So having built the trust issue with human as well as the tech on climate fintech, why look, we are still having some of the, facing some of the challenges for climate fintech at growth phase to attract investment capital?
Yeah, just to build on what you were saying, my PhD was about how to manage uncertainty around big modeling projects. So there's a great aphorism from someone called George Box that, all models are wrong, but some are useful.
Some are interesting.
Some are interesting, yeah. And really, like, what it matters is like what you value. It comes down to fundamentally to like human values, and you can build a model in all sorts of different ways to do all sorts of different things. But yeah, so onto this question about like the growth phase. So I guess the thing on everyone's mind of what I said earlier was about the sort of macroeconomic conditions. In the sort of like venture market, the growth phase is a little bit more sensitive to macroeconomic conditions. That tends to filter through to valuations a bit quicker than the sort of seed and pre-seed and whatever you call the ultra pre-seed stuff that we do. So that will affect things. One of the largest issues that VCs talk a lot about is just fundamentally at the growth stage, cost of capital is super important. A lot of VCs are continually counseling their portfolio companies to go to the States as quickly as you can, because there's just a lot more easy money and a lot more money available for venture, and also certain aspects of the financial system are set up to allow easier investing into venture funds. But then again, there is still some good capital around. I mentioned like a number of like quite exciting rounds that have gone through in the last year. Some of the biggest rounds that we've seen in Europe around FinTech, around climate, have been sort of FinTech-flavored ones. And Europe itself is actually, I think there's about roughly the ratio is there's about $1 billion in venture funding roughly for sort of climate FinTech in Europe, and maybe 700 million in the United States. So Europe is actually a great place for this. Where I think there is generally a sort of real gap in the sort of climate finance stack is somewhere kind of between sort of seed and growth. There's a real gap for what are called, like, especially first-of-a-kind projects. So this actually doesn't really affect fintech so much, but is especially a thing for hardware. Basically, how do you manage this transition from going from having intangible capital, ideas, designs, into having something on the ground before infrastructure investors are going to be comfortable with taking that risk, and after venture investors are going to be like, So
this is exactly what the UKFin money is for that kind of stage where you're at the real ideation stage, but you haven't really got a proof of concept.
Exactly, yeah.
And so therefore, if you think about it, you've got the brains on both sides. You can have the technologists like Professor Will Nottenberg here is a quantum computing specialist, is in the FinTech Centre here. He's one of our directors. So you could access his team to look at, am I getting the best? Where do I want to go technology-wise? And then you could also trial it with some of your potential customers or customers you've had in the past, or a group, to actually test it out. And then the next phase could be then to go to somewhere like ZINC VC, or I'm also luckily enough to be invited to be a fellow. So we've just gone through rounds of advising startups who are looking into financial resilience and well-being, which is something I'm really happy to do. But I think there is this gap here, and that's why it's been recognised that if we can meld it and bring in this network, then we're actually filling that gap between sort of startup funding and then where do we go to get the VC and do the development aspect in the middle.
And just building on that, I've spoken this week with, there are some like UK-based philanthropics who are also thinking quite seriously about what they can do to sort of do sort of quite irregular granting things at this gap to take, basically be willing to take the first loss.
Like put them our way.
Yeah, absolutely.
Just because of
sorry, I was going to go to a grants-based question. So you mentioned Innovate UK. So we looked at applying, and there's a company called Grantify that says that they win 60% of each cohort, and that's a great advert for using their services, which cost £5,000 to £10,000. But that seems like something's going wrong in the way that those grants are being awarded.
So I've had conversations with a number of portfolio companies about that. Yeah, sorry.
We have to open also for the
audience
questions, and because of the timing now.
I can talk to you about that after.
Any audience questions? So, any question from the audience?
Stun them into silence.
And I can follow up with the final question. How can we make climate finance more inclusive? Yeah.
I think
You
kind of covered that one.
a lot around that, but if it just...
What I would say is we need to break this model where I know Lida was supposed to be on the panel here,
Yes.
but what she would have said, having worked in banking and looking at investment for 20 years, what she would have said is, we look at the risk, then we try and estimate the value, and then we try and lock it down so that that model stays consistent. We need more agility around, because the problems are so diversified that we've heard, we need to broaden our thinking around adaptation. We're quoting theories. We go back to Darwinism, The survival of the fittest comes back to those who adapt. You don't adapt, you don't survive. It's a very simple theory, but it tends to hold true, whatever sector you're in. But again, we need to break this model of risk, defining what value is, and then just locking it down and seeing that it's a fluid position between investment and what we need to do and how we invest. So we'll have a chat with you about the funding models, because no funding is easy to get, whether you're in academia, whether you're in industry, or whatever you're trying to do, whether you're in councils, etc. And I think this is what we need to rethink in order to get the best. I keep getting told, there is money out there, there's money for investment, but you try and get it, it's much more difficult to apply it to a purpose.
I think raising a venture round is where I've been most aware of my privilege ever in my life, and that is because venture investing is very irrational, and so you're trying to convince a set of people to make a decision very quickly that's by its nature irrational. Venture investing is based on most companies failing, and so your brands and the amount of time that you can just wait and not pay yourself a salary, and what you bring in on your CV and the confidence you hold in a room, all these things become much more important than they really should be. I've got no solution, but it's certainly something that felt very keenly.
Yeah, I think the venture industry is basically full of people who look a bit too much like me and sound a bit too much like me, privileged white guys, and that's something that people are keenly aware of. And also entrepreneurialism it's not just about financial capital, it's also about the social capital and the networks that you have access to that really exclude people and diverse founders from getting involved. Something we're very passionate about at ZINC is that we have a high representation of both female founders and I think minority founders on each of our cohorts, and that's kind of part of our raison d'etre, to make entrepreneurialism a path that people who maybe don't have those dense social and financial networks available to them.
I think that comes back to the concept of value. What are we valuing? How are we shaping that value? Is it a social linked value, or is it just, this old dichotomy between profit and purpose, and is profit still, overriding the purpose of protecting the planet, like the 3 Ps, like you said? And I think that is a discussion that we continually need to have in VC, because I've also heard from female founders that when they go for VC investment, they're told to go to the US, that's one. Secondly, they're also replaced by a male equivalent to get the funding. So these are discussions that are not discussed, but these are the reality that's coming in, and that's evidenced by Innovate finance data as well.
Thank you very much for really a fruitful discussion. And just to summarize on the key points of this panel, so we see that there is available funding for pre-seeds and also startups and for growth phase, as well as with a close collaboration across sectors and industries, universities, we might have a better impact on climate change, and increase of human and tech trust will be more into directing capital to the climate fintech. So thank you very much, everyone. And I leave you. Yes, you have.
Yes, just I want to share something. Maybe there is already a solution. We can use it inspired by Saudi Arabia vision there. I come from Saudi Arabia now. Thank you for all. Just I want to share something here. I came from Saudi Arabia yesterday. Just I want to share what happened there in the market. I agree with you that the banker already just checked for the value and the risk and the purpose. So can make a cooperation, I think, between the private sector and the government sector with the academia sector, university and research center. If you work all together, they can make a solution for something like that. Now, the PIF there in Saudi Arabia, it's the arm of the investing there. It's already funded by the Saudi Arabia government. So that share start with the hydrogen plant there in NEOM. So it's a big risk there for the private sector to share or starting the work by themselves because they worry about the refund or what happened for return of the investment. But if the government make them invest and start that and push the private sector to work with them and already supported by the academia and university center, I think that can make something there and make it happen and be quickly growing because the government and investment fund have $1 billion. So already they wait, no problem for them to wait for 2 years, 3 years, have a purpose for that. They already want to for the climate change or something like that. So you cannot just demand right? Like that.
To look at these various aspects.
So should be government already start something, doing something now to push the private sector to follow them for area, it's high risk for return for investment.
So what you're talking about is commonly referred to in innovation here as the triple helix model of innovation, the partnership between government, academia and business. It was sort of part of a sort of big second wave of innovation thinking that came about. And yeah, the Vision Fund is massive, and Masayoshi-san likes to take risks.
Thank you.
Thanks for engaging and sharing that. That's brilliant. Thank you, everyone.